I'd like to welcome everyone to our webinar that's dealing with succession planning. Succession planning has become, I think, an issue that is on all of our minds as we age. If we're lawyers, accountants, advisors of any sort, certainly it's incumbent upon us to be fully aware of the fact that we have a rapidly aging population. Many opportunities have come about over the last several years that can provide very superior tax advantages for family businesses. And for that purpose, I'll turn things over to Jordan Louie. Jordan, you would like to perhaps introduce the group?
Yes, absolutely. So to start with first, I'd like to introduce the panelists that we have today. And so Todd serves as the senior partner of Quantum Business Law. And Todd has been practicing within tax and estate planning for more than 30 years. And during that period, he's spoken at dozens of events to bodies such as the Ontario Bar Association, as well as the CPA Association of Ontario, as well as Alberta and British Columbia, I believe, just to name a couple of examples. Secondly, we have Ryan Gung, who serves as a senior associate of Quantum Business Law, and he's specializing within wills and estates law. And I am the client services manager of Quantum Family Offices. Primarily, my responsibility is within financial planning. And Todd, I think, would you mind just changing the slide? And so one thing just to really preface our conversation would be really some of the complexities surrounding income tax in Canada, as well as in general. And Albert Einstein, really, for all of his genius, all of the mathematical and scientific discoveries that he's contributed to mankind, one famous quote of his was that the hardest thing in the world to understand is income taxes. And so, I mean, I'm sure there's a lot of exaggeration when it comes to that point, but it really just sort of illustrates how complex income tax issues can be, really, depending upon the situation. That even Albert Einstein himself had some difficulties in that respect. And so, just in terms of encapsulating our program today, these are a few of the primary issues that we'll be discussing further. The first of which is really the importance of objectives. And so objectives really dictate the path that's followed in terms of estate planning, in terms of designing one's corporate structure, as well as their will. And every family has their own, every corporation has their own sort of unique wants, things they're afraid of, as well as unique plans to institute in the future, as well as priorities. And so why is setting objectives effectively important? Let's just start a conversation off with that point.
Maybe I'll chime in, Jordan, on this issue. So what I would say at the outset is that all too often, we have business owners, accountants, lawyers that contact us seeking advice for different things, but almost every time we have individuals who come in who essentially have expressed to us the solutions that they're looking for. Now, that's fine. There's nothing wrong with that. The issue, though, is that failure to consider one's situational circumstances, one's objectives, can lead to a very ineffective tax plan. We have such strong conviction on this matter that we actually have coined the phrase OPS, which is objectives, problems, and solutions. We look to first understand the situational facts of a client, their family dynamics, their corporate structure is very important. But what's most important, once that's understood, is determining what are the true objectives. And once we understand those things, then we can identify problems that stand in the way of achieving them, and ultimately solutions that are aimed at resolving those problems. And part of it is very personal. As an example, you may have a situation where there's the intention to treat all children equally from an estate planning point of view. It might be that the treatment is not equal for a number of reasons. There's no right or wrong answers. And of course, what's critically important is the corporate structure. One of the things that we'll talk about through the course of today is the center of active business. So we believe in order to properly assess the types of problems and objectives that we're faced with, in order to provide corresponding solutions, it's critically important to really fully understand the corporate structure and understand, as an example, where is the active business and where is the non-active business? How do we create connectedness? How important is asset protection? Perhaps someone will say, well, I don't care about asset protection. We've never been sued and you never will be sued. Well, that's fine. That may be their view. And we respect that. And it could be that we would proceed to do planning according to that on the basis that that person is not concerned. It may be that we have, say, a release signed for advice that we're providing and an acknowledgement that these things are not being addressed. Other people will say, well, after I die, I really don't care about any of my family members, which again is no wrong answer here. Other people say quite the opposite. If you're relying on your accountants and your lawyers, if you're a business owner, in order to provide advice based on your situational facts only, then you're missing out on much as far as consideration that has to be taken. If you're a lawyer or an accountant and you're involved in planning, then I believe that these steps cannot be overlooked.
Great, amazing, amazing. And so part of our theme today was speaking about strategies for retiring shareholders. And so what benefits are there that are available to retiring shareholders? Ryan, perhaps did you want to give some examples?
Sure. So one of the tools that we're going to discuss is the new piece of legislation. It was named Bill C-208. It started off as a private member's bill, and it became a law in 2021, and it went through an amendment in the 2023 budget, which introduced a whole new set of rules, which are intended to close off some of the loopholes that they considered. So why did they pass this new law? The legislative purpose of this Bill C-208 was to help the owners of a small to medium-sized businesses to pass down their business to the next generation in their family. So that can be their children or grandchildren. So what changed because of this law? Prior to this legislation, the parents, when they sell their shares to a corporation that is controlled by their children or grandchildren, it was looked upon as a non-arm's length transaction. So the proceeds of the sale were taxed as if they were deemed dividends instead of capital gains. So what that meant was that these parents, they were not able to take advantage of certain tools like lifetime capital gains exemptions. So if you claim lifetime capital gains exemptions on the proceeds of a sale, then you can deduct up to $1.25 million. So it's essentially it can be tax-free disposition. Now, with the passage of this law, Bill C-208, the parent can keep the business within their family by transferring their business shares to their children, to a corporation owned by children or grandchildren, and they don't have to feel the pressure to sell those shares to an outside party, a stranger, just to be able to claim their lifetime capital gains exemptions. So the purpose, as you can see, the purpose of this legislation is to facilitate intergenerational transfer of a family business and keep it within the family. And at a latter part of our presentation, we're going to discuss the conditions that they have to be met, both by the parents and also the children.
Amazing, amazing.
Okay.
Great.
One thing I'll just check in on that note as well, if I may. Sorry about that, Jordan. That in reality, when Ryan is talking about intergenerational transfer and so on, we're obviously talking about during the lifetime of the parents. And what's very interesting and enticing about this concept is that if there's no cash available to purchase the parent shares, we can still trigger the capital gains exemption and use as an example promissory notes to purchase the shares, which can be satisfied over a period of time. Say, pick round numbers, say it's 10 million, say you pay $1 million a year for the next 10 years to buy the shares. Well, that 10 million would essentially be tax-free. Well, no, so I'm sorry, 1 million of that, 1.25 million would be essentially tax-free. And that would be assuming one capital gains exemption. So it's really more a matter of saying, how do you sell the shares without having the capital, the funds available? In the event they're not available, then it would be a matter not of $1 million a year, but 100,000 a year for 10 years, but that would be tax-free. That's an important qualification. Sorry about that, John.
No problem, no problem. And so we talked about the facilitating the sale of a corporation to family members using Bill C-208 just briefly, but what considerations should be made in general when we're discussing the sale of a corporation?
Well, I think there are many considerations that have to be made when you're considering, from a tax point of view, is what I'm referring to, when you're considering the future sale of a company. Is it an asset sale? Is it a share sale? Well, clearly, if there's an intention or a hope to be qualified for the lifetime capital gains exemption, which I previously mentioned was 1.25 million this year, and of course it's indexed, it continues to raise each year. So the issue could be many, but I'll suggest some main issues that need to be thought of. And one, which company is going to be sold? So as an example, if you have a holding company with a dozen subsidiaries under it, multi-stacked the corporate structure, and so on, and you're considering selling one of the subsidiaries, say an active business, and perhaps you're not considering selling a holding, rather a real estate property that is occupied by the business, as an example. Well, it's important that you understand that in order to claim the capital gains exemption, you have to sell the shares at the top, at the holdco level. And if the holdco has all these other subsidiaries, you have somewhat of a problem. So oftentimes the separation of companies needs to be done. And throughout this session, we're going to be talking about focusing on the circle of active business. A lot of you who have done estate freezes, have trusts, and have done quite a bit of tax planning say, well, what do I do next? And if you're lawyers and accountants, I often hear the complaint, well, you know, this is my biggest client and I'm not quite sure what to offer. Well, one of the things to focus on, if you've already done this other planning, is to really say, okay, where is that circle of active business? And how do we focus on that? How do we consider separation of active businesses from non-active businesses? How do we consider the whole question of eligibility for the lifetime capital gains exemption? Not only that, what do we do about significant assets such as investments or cash even that's inside of these companies? Because no one will buy the cash in your company at any equitable rate. And as far as investments, presumably you have to take those out and suffer a taxable dividend in the process. So I think that tax planning has to be done, generally speaking, in excess of 24 months prior to the sale of the company. Many strategies that we will introduce have to be done before you're in contemplation of the sale. Once you're in contemplation of the sale, there's anti-avoidance regulations and issues there that we may have to be worried about. But in general, it's restrictive. If you wait until you have a buyer at your door, you're already contemplating a sale, you're in negotiations, it may be too late to do a lot of the important items that, or take the important steps that I've just been describing.
Great, great, amazing. And I mean, when we're talking about the sale of a corporation or other disposition, whether that's from the unfortunate death of a shareholder, claiming the capital gains exemption is very important, but there can also be opportunities to be able to multiply the capital gains exemption. And so that's really the question, is this achievable? And so Todd, how can the capital gains exemption be multiplied, just in a nutshell, essentially?
Well, taking a step back, we've identified that the capital gains exemption this year is 1.25 million. Now, that may or may not be significant, depending on the company. There are certain situations where the capital gains exemption is just too small to worry about, and obviously there's no eligibility, and we move on. In other situations, planning has been done in a way that you are able to capture numerous capital gains exemptions. Say, as an example, you could capture 10 to 20 capital gains exemptions. And the planning and family dynamics and other reasons would allow that. Well, all of a sudden, doing quick math, you can see that it's not such a small number anymore. This can be done by the utilization of beneficiaries and the allocation of the sale of shares to various beneficiaries. So planning can be done in that regard, but again, it really comes back to the original comment that we made about ops, understanding the objectives, identifying problems, and offering corresponding solutions. That's really what it's about. There's no one size fits all. It really has to be designed with the situational facts clearly in mind.
Right, and I think you answered the next point in that part as well, regarding the estate freeze, and just, yeah, again, it depends on the objectives and the priorities of the shareholder, and what they're willing to achieve, what they'd like to achieve, and what they're willing to do to get there, essentially, right? Next we have wills, and so many shareholders, as well as individuals in general, die intestate without having a will in place. And so, Ryan, I mean, how important is it to have a will in place?
Yes, so the biggest difference between dying testate and intestate, having a will and not having a will, is that without a will, you don't get to choose who will be your executor. So essentially the manager and the person who will gain access to all your assets and be in charge of distributing the assets to the beneficiaries. Without a will, we'll not have control who that person will be, even though it's such a crucial position to consider. So it'll be somebody who will volunteer to be in that position or have to be court appointed. So you have no control over how your assets are going to be managed. And the second disadvantage of not having a will is the complexity that it adds to the probate process. So without a will, there's a separate and different probate application process, and it involves someone volunteering to be the executor, and also that involves all the potential beneficiaries consenting to that volunteer position. So it can be quite difficult to gather all the consent if the potential beneficiaries are spread across the country. And all those documents have to be signed in person in wet ink. So imagine the difficulties that it may entail if you have to go to BC to meet somebody to find a potential beneficiary so that the volunteer executor can obtain that signed consent. And if that cannot be obtained, certain legal channels have to be explored for exemption on certain conditions and requirements. So with those two factors considered alone, I would say you should really try to avoid dying intestate.
Right, that's a good answer to that question. And so one of the next points when beginning estate planning in general for corporations would be really being able to effectively determine the center of active business and separate the active business from non-active businesses, as well as being able to separate the appropriate assets involved. And so there's two different terms that we have here, right? So we have active business corporations and small business corporations. And so what are the minute differences between the two categories?
I'll chime in on that if you like, Jordan. So I'd say the following, that active business corporations are just as the term implies, in contrast to non-active or passive businesses, which are not, do not earn active business income. So that is pretty self-explanatory. I don't think it requires much more. A small business corporation is often misunderstood. People often think of small business corporations as being small companies. Well, that's the farthest thing from the truth. As a matter of fact, many SBCs or small business corporations are very large companies. So the test really is about the composition of assets, for one thing. So in other words, at the time, and I'll jump to the next point there if you don't mind, Jordan, because it's connected to the first one, 90% of the assets held by the company must be actively used in Canada. They must be considered active business assets. And that would be at the time of the sale. The terminology in the Income Tax Act states that all or substantially all of the assets must be actively used in the business. That's generally held to be 90%. There's a second test that is referred to on the slide, and that is that 50% of the assets must be actively used in the business for 24 months prior to the sale. And by the way, that goes for death as well. this whole concept really relates to understanding how you can position these corporations, whether they're active businesses or whether they are in fact small business corporations, in the right strategic fashion. All too often we see corporate structures that commingle all of the above, as we've been discussing. Do you mind if I just go into the next couple of points there? I'll just cover the cash floor and ceiling. I think that, since non-active assets are considered to be detrimental insofar as the shares of the company are not eligible for the capital gains exemption, if you're hoarding cash and so on, you need to not only determine the floor for how much cash is required, but also the ceiling. So the floor is very simple. You say, okay, we need, so many months of payroll, so many months of general expenses for the company to be covered, and so on. That's fine. But the ceiling is a little bit more complicated. And of course, the test that's used for that is fairly stringent. There's two court cases. One is a Supreme Court of Canada decision. The other is a Tax Court of Canada decision, and both essentially refer to these assets in the following ways. One case, as an example, states if the withdrawal of the funds, would the withdrawal of the funds from the company, from the corporation, have a decidedly destabilizing effect on the company? And if so, then it's considered non-active. That means if you have $1 million in cash sitting in the company, but you only need $200,000 to run the business, you have $800,000 of cash that's costing you any capital gains exemptions. You might have already done estate freezes and set up trusts and done all kinds of elaborate planning, believing that you're multiplying the capital gains exemption, and possibly you don't even have a single exemption. So all of those things need to be taken care of for the future.
Right, perfect. And I mean, when we're talking about taking care of assets for the future in the next generation, one important point to pay attention to is really estate equalization when it comes to meeting the objectives of a family. And so every situation is a little bit different. And so at times you have certain children of a shareholder that are involved with the business, certain children that have absolutely nothing to do with it. And so one thing that many shareholders have is a priority or an issue that keeps them up at night is how can I, what happens when I die? How can each of the beneficiaries of my assets be equitably taken care of? And so one thing is being able to ensure liquidity to be able to provide for this equalization of an estate. And so what are some strategies that can be used in this circumstance?
Well, I think there's a couple of things. And I think one of the important things to recognize is that taxation can erode the amount of capital that's available for distribution to an estate. So to the extent that one is considering what are the implications of tax at death, then the good news is that much of the planning that can be done is centered around the current value of shares of companies. So it's very, very important to identify the value. And I'm not suggesting for a moment that that it's an easy task, but I think it's certainly worth focusing on having a proper valuation done that would at the very least provide an approximation of the value of those shares. And one reason is because there's steps that can be undertaken that can essentially freeze the value of those shares today, so that at death you already know what your tax liability will be. So that's one way of controlling things. It's often the case that assets have to be sold in order to pay taxes, which is rather unfortunate. And it really, again, depends on what the preferences are for each client. But at the end of the day, if you're attempting to preserve the assets, then there's certain steps that can be taken, such as what I've just described. As far as liquidity is concerned, well, an easy solution for that is life insurance. Life insurance can be used in such a fashion that it does provide equalization of an estate. It might be there are children active in the business, and other children who are not. They have other careers. They're located elsewhere in the world, and all of that. And the good news is that all of those things can be better achieved, if you are using certain tools in a certain fashion.
And I think just to add to that, I mean, one point that's really sort of increased the importance of these estate planning strategies is really just sort of the increase in the capital gains tax inclusion rate for assets of a greater value. And so the inclusion rate is now increased 66.67%. And so again, the burden is now higher in those circumstances upon disposition or the sale of a corporation. And so it's more and more important that we're looking at really tax effective strategies. And the next point that we wanted to talk about as well for active businesses is why is asset protection important, and what are some ways that we can achieve this?
Well, I think that it's not only important from a standpoint of an active business, but for any assets whatsoever. So there are certain provisions that are available, as an example, in the Insurance Act that is helpful from an asset protection point of view. We have the law of trusts, which provides certain benefits there. There's lots and lots of ways that we can achieve certain types of asset protection. But why is asset protection important? It's important because we are all vulnerable. Sometimes we're not necessarily mindful of that. When you consider that 50% of marriages end in divorce, then one must consider the potential for a claimant or a litigant being a family member. I don't need to tell anyone about the risks of, say, lawsuits from suppliers, from contractors, from employees, any number of places. So I think that asset protection is quite important because, number one, it's achievable. There are certain regulations and rules, such as the Fraudulent Conveyances Act, which is provincial legislation existing in every province in Canada, but yet by a different name, which can create some kind of an impairment. At the end of the day, it's, I think, critically important to position your assets in such a way so that you do have the kind of protection. I'll just cover the next point too. It mentions about trusts and life insurance. Well, life insurance has, I would say, a sacred status, in that sense that life insurance proceeds are completely tax-free, up to a certain level, that is. But not only that, that's from an income tax point of view, but from an asset protection point of view, where you have a named beneficiary, you have significant asset protection that you wouldn't get in other sorts of asset classes necessarily.
Very good, very good. But it's important that it's structured correctly with the correct policyholder as well as the named beneficiary that Todd had mentioned. And I think just one thing we wanted to cover quickly as well was really just income splitting when it comes to trust, because I mean that's a very common question we get whenever we talk about trust. And so just before we go into the parties that are involved with the trust, what are some of the restrictions to be aware of within the TOSI rule?
Well, TOSI rules, I think there's many issues to be aware of, but I think what we're dealing with at this moment is really, what is a family, what is a trust? And of course, making a distinction between inter vivos trusts and testamentary trusts created by the will, I think is quite important. Inter vivos trusts are intended for the living. They're things that you can benefit from during the course of your life. And in order to achieve proper asset protection, I'd suggest that since there are beneficiaries within a trust, certainly there are certain ways that you can create protection. Insofar as the courts are even reluctant to break a trust in the context even of family law and of other types of claims. So unless, of course, you're attempting to deliberately defeat a creditor. And then, of course, what I mentioned previously, as far as the Fraudulent Conveyances Act, those things are important. If you're attempting to defeat a creditor, to defraud a creditor in some fashion, then the courts do have significant power to make an award that can result in undoing certain asset protection strategies that you may have undertaken. So that's important. The other thing that's important is connectedness, ensuring that you have proper connectedness between companies. So previously we talked about active businesses and small business corporations, say, being completely separated from a structure that holds other subsidiaries, such as real estate companies, investment companies, other non-active companies. So one of the issues becomes, if these companies are separated, is there a way to connect them? Well, something that a lot of planners are not necessarily familiar with is that trust can provide connectedness between corporations. insofar as intercorporate dividends from an active business can flow through a trust, not as a genuine flow through, but it can flow through to corporate beneficiaries, which say are investment companies. And the reality is that when these tools are used properly, they can be used to resolve multitudes of problems. Again, very situationally, it's a situational question as to what members of the family are we attempting to provide benefits for, how are we intending to treat them, which companies are intended for which individuals. All of those things need to be very carefully considered based upon the objectives. So again, these are only tools. These are not, necessarily the right solution for everyone. So I hope that helps. TOSI rules, well, yeah, the TOSI rules are tax on shared income, and they're essentially intended to prevent income splitting. Where there's beneficiaries of a trust, as an example, and we're paying a dividend to beneficiaries, there's certain requirements that exist there, and they're complicated regulations that have to be looked at very closely.
Sure. Maybe we'll just go into the next slide that'll just show some more detail in terms of the different parties of a trust that we have there.
Can I make a short comment about the trust in the context of Ontario family law before we move on?
Go ahead.
So I just want to make a comment. So this is something that anybody should be careful about. The case law regarding how trust beneficial interest is treated with respect to equalization payment is constantly evolving. So, there used to be a certain consensus that a person's interest as a beneficiary of a trust is protected from family law claims, but certain case laws just come up and then it constantly changes. And there have been some jurisprudence that said beneficial interest of a beneficiary of a trust can be calculated as part of equalization payment. So this is something that one has to be mindful of, and more complex planning may be required to take this into consideration.
Right.
I think that's a great.
Sorry, go ahead.
Yeah, I think. Oh no, I was going to say, Brian, I think that's a great point. All too often, individuals, feel smug or secure where they shouldn't be. Now, I think that one of the issues in the context of family law is that, introducing children directly as shareholders presents a certain problem. Having children introduced indirectly, say as beneficiaries of the trust that hold the shares of companies, I believe provides some degree of assurance, but not complete. In other words, in the event that there's a child who's a beneficiary of a trust and he happens to be involved in a family law dispute, the individual can argue that he has no automatic entitlement to a benefit because the trust is fully discretionary. He may have no entitlement whatsoever. Whether the courts would accept that, as Ryan's saying, is a different matter. But at the end of the day, it's very, very important to understand the risks, understanding how you can navigate a very complicated situation. Nothing is 100%. Sometimes there's risk that we tolerate. But I do agree with that certainly in the context of family law, there's always risk that the assets held by a trust could be either, well, not likely attached, but a corresponding value may be applied. In the context of estate law, I believe that there's also significant concerns that beneficiaries of trusts and the sanctity of a trust may not be upheld for a number of different reasons. So I think having our eyes wide open is the key.
And so what are some examples of problems related to a structuring of a trust that can be problematic when it comes to different parties of the trust in terms of who's designated as each as a settlor, for example, or a trustee?
That's a very interesting question. And, I'd say that at the end of the day, there are a number of ways that bad trust planning can factor in. There's what's called reversionary rules, where under certain circumstances, tax implications can be reverted back to a settler. Now, before we get into that, I think it's important just maybe to explain the roles of each of these. So a settler is an individual that would be contributing some capital to the trust in order to settle the trust. The trustees are the individuals, and sometimes it's, say mother and father, it's the parents that are trustees. And when you consider that, oftentimes the same individuals are beneficiaries. Well, in that context, it could be that CRA could take a position that this trust is self-dealing insofar as the trustees and the beneficiaries are the same individuals. So it's maybe important to consider a third trustee. If it's mother and father who are trustees, perhaps there should be what I would call a friendly stranger added, which would be an individual who would be become a trustee. So that because the issue is as follows, that the trustees have the capability during the discretionary period, meaning when they're alive, to be able to essentially roll out the assets to beneficiaries, including themselves. It could be considered a sham trust in certain circumstances. So trust planning is very, very important. The concept of a protector is also, interesting too. And we often use that in jurisdictions outside of Canada. Can be used anywhere, really, but it really would normally be a committee who would provide a letter of wishes to the trustee that would request that the trustees consult them on matters before making a decision. And oftentimes, if there's a corporate trustee, rather than having the mother and father themselves, it's something that makes sense. Why? Because you have accountability between a corporate trustee and the protector. So we can have it designed in a fashion that the trustees can be replaced. So I'd say that at the end of the day, there's a lot of issues at hand, and it's very important that when trustees are set up, the same individual, as an example, is not a settler, a trustee, and a beneficiary. There's lots of reasons for that are far beyond the scope of our program today, but certainly there's a minefield that anyone endeavoring to do long-term estate planning with the use of estate freezes, trusts, and other things such as butterflies and other strategies have to be aware of. So this is really, again, why we're saying let's first focus on the objectives. And at the end of the day, it's the client that decides, okay, turn left, turn right, slow down, speed up. They provide that information. First of all, understanding, again, that there's no right and wrong answers. It's really a matter of making sure that the outcome is in harmony with what the situation and objectives of the client are.
Perfect. That's great. And I mean, we're getting quite close to 12:45 at this point. So I think let's maybe just bring the slide to the case study that we have to discuss. And I did notice as well that there's a number of questions just in the question and answer section, but we'll be looking to answer questions just at the end of the program. So the next slide here is really a case study of quite a common structure that we see. We're referring to it here as an ineffective corporate structure, at least when it comes to a tax perspective, just depending upon the situation, not always ineffective. One of the problems here we see is that non-active assets are commingled with active assets. And I mean, as we were illustrating before, it's very important that they're separated correctly when it comes to corporate purification, as well as eligibility of the shares of a corporation as QSPC shares, so that the capital gains exemption would be usable upon the sale or disposition of the shares of these corporations. But I'll just point out a couple of different things that we have here. So the holding company, for example, is holding marketable securities, cash, and GICs. And so this is quite common advice that we see. Oftentimes, it's moved here to be able to provide protection from creditors for non-active assets. But what are some problems with having these assets within the holding company?
Well, we've been talking at length about the fact that the eligibility for the capital gains exemption is not automatic. We've also talked about, asset protection in a few different contexts. So I'd say the following, that, if we were to consider this middle one right here, which we haven't talked much about, which is loans. So as an example, there's a loan that's made to purchase property to an investment company from the active business. There's also a loan for purposes of investments that are made to this investment company. And there's also loans that are made outside of Canada, which all of them have tax implications that I think, are worth considering. So let's talk about, first as an example, where there's real estate involved. And of course, the individuals were prudent enough to set up a separate corporation to create limited liability with respect to that asset. So in other words, they protected the real estate in the event that the active business is sued. Well, then they're not likely going to lose the building because they have a separate corporation. Good planning, fine. Bad planning is the loan. So the loan from the active business, from the operating company, over to the real estate corporation is problematic, because in the event that the active business is sued by a client or by a contractor, an employee, or virtually anyone whatsoever for liability purposes, then the building is now at risk. And why is that? Well, first of all, there's a debt that's owed to the corporation, to the active business, to the operating company, and it's owed by the real estate company. So in the event that an individual was to sue the active business, the operating company, they would very quickly find out that there's an asset on the books, and the asset is a loan to the real estate company, which could easily be called. You could force the real estate company to repay the loan. In the event that the real estate company did not or cannot pay the loan, then the litigant could then petition the real estate company into bankruptcy and take the building. And that would be pretty catastrophic. So I'd say that there are a few problems that we see all the time. First of all, at first glance, you can see that we do have the scenario we described before. We have a holding company with various subsidiaries under it. And the fact that that in itself means that you have to consider at which place you're going to sell the shares if the company is sold. So when we're talking about selling the company, it also applies to dying. And one of the things we can't choose is when we die. So at the end of the day, if there's a deemed disposition, meaning at death, if the shares are deemed to be disposed of and the disposition is taxable, or in the event that there's a sale to a third party, as an example, well, one of the huge risks that we have is that we have all of these assets. Life insurance policies should never be in the active business. Why? Because depending on the health of the person, it could be deemed that the life insurance policy presents a significant asset value, which could be deemed as a non-active asset under the Income Tax Act, Section 110 of the Income Tax Act. The other consideration, of course, we've already mentioned, being real estate. You don't want that in your active business for the obvious reasons. And then, of course, if you're lending money to a foreign corporation, there's certain tax implications that you have to be abundantly aware of. When you're lending money from a corporation in Canada to a corporation outside of Canada where the same individual controls them. And so these regulations are complicated, but one of the things we see almost always is situations where these things people are running afoul of these issues. So the active business is profitable, it's pushing up dividends to the holding company, it's got cash, GICs, and marketable securities, all of which eliminate any possibility of eligibility for the lifetime capital gains exemption. In contrast to that, just to move along quickly in the interest of time, the entire concept of focusing on the center of active business allows you to be able to achieve a few things. One thing is you can separate to the left side of the screen your active business assets, and to the right side of the screen you have your non-active assets. And by the way, issuing loans, if you are issuing intercorporate loans or related party loans, doing so from a non-active business is a lot smarter than from an active business for the reasons I've already described in relation to asset protection. Not only that, but we also mentioned previously that in the context of a trust can be used as a flow-through that allow you to be able to essentially move funds. So it requires a dividend policy. A dividend policy understanding who the recipient company should be. And essentially you can have numerous recipient companies that are all connected through the trust as beneficiaries. It allows you essentially to be able to navigate and create conduits to be able to move funds for various different reasons, whether it's because of tax planning or whether it's because of asset protection. So that's a fundamental, very simplified description of why you need to separate your active assets from your non-active assets. If your current structure is that you have one or more holding companies and you have a whole spider web of companies underneath, this issue needs to be focused on in order to prevent serious problems.
Yeah, that's right. And so we have another structure here as well that would be depicting the use of a trust, but also in concert with some of the Bill C-208 planning structures that we had mentioned previously. Ryan had introduced the topic, but now at this point, just quickly, did you want to elaborate a little bit on some of the benefits of this new legislation, as well as how it would be used within this case study, Ryan?
Yes, sure. So as you recall, the legislative purpose of Bill C-208 is the intergenerational transfer of a business and keeping it within the family, and also to provide a vehicle for the parent to genuinely retire from the business. Before the amendment in 2023, which introduced some of the conditions that I'm going to describe, the lawmakers have noticed that this bill was kind of being abused for retirement related purposes, even though the whole purpose was to allow for the original shareholder to exit from the business and pass it down to the second generation. So what they introduced are follows. So there are certain things that both the parents and the next generation have to do. So at the initial disposition and within a certain time limits. At the initial disposition, the parents must transfer a majority of the voting shares and also the common growth shares at the time of the initial transfer. And if there's a remaining of those classes of shares, they have to dispose of that or transfer to the next generation within 3 years from the initial disposition. And parents also have to give up managerial control of the business, which is kind of hard to prove. But still, the law says that the parents have to give up managerial control over the business within 3 years from the initial disposition. Now, children also, they have to retain the voting shares that they received or bought for at least a minimum of 3 years from the initial disposition, and they have to remain actively involved in the business for a minimum of 3 years. These 3-year periods can be extended to 5 years if the parents choose to retain what's called factual control over the business. The factual control is more of an abstract concept. It depends on the circumstances and the facts of particular family businesses. So if they somehow want to retain this factual control over the business, then the children will have to, they have to retain the voting shares and also active involvement in the business for the next 5 years instead of 3 years. Those conditions have to be met in order to be able to claim the lifetime capital gains exemptions for the disposition.
Perfect.
Yeah.
And so what we're picturing here is the Sons Corporation purchasing the shares of ABC Group Limited here, which has the mother and father. They held they're holding free shares with a value of $1 million. So they've done an estate freeze previously. And what we're illustrating here is the Sons Corporation purchasing these shares over a 10-year period, with 100,000 being dispersed each year. And Todd, could you expand a little bit about how the promissory notes are being used in this circumstance?
Yeah. Thanks, Jordan. I'll do that. So I think the important thing to understand, first of all, is that this particular diagram demonstrates a situation where cash may not be immediately available. So first of all, we would establish a corporation as a beneficiary of the trust. And the reason that are doing that is ultimately because intercorporate dividends can be pushed, say, from ABC, in this case this is a fictitious name, but it can be pushed up through the trust and back down to the son's company. Now, having said that, at this moment, we're looking to trigger the sale of mother and father's shares. And we do that not with cash. We do that with a promissory note that would provide for the purchase of the shares today, but the promissory note is like an IOU. In other words, say over the next 10 years, that promissory note would be satisfied by paying $100,000 a year for the next 10 years. That $100,000, starting in, say, the second year, would be paid up as an intercorporate dividend, be tax-free to Sunco. Sunco would then use those proceeds to purchase the share, to satisfy the promissory note. And of course, that would be tax-free. So in other words, mother and father receive $100,000 a year, tax-free for the next 10 years. Now, conceivably, that amount could be $2.5 million rather than $1 million. Since the capital gains exemption is currently $1.25 million. If we utilized the full exemption for both mother and father, then somewhere in the order of $200,000 a year, a little bit more than that, could be paid to mother and father over the next 10 years with no tax whatsoever on account of the capital gains exemption being triggered by the use of the promissory notes. And again, when we use this expression, identify the center of active business, this is only one of at least a dozen reasons I can think of that it's critically important to isolate this active business circle. And then it allows you to be able to do a lot of planning. It also allows you to prevent problems. As an example, say that this structure happened to be over here, and say that we have a connection between the two. Well, how do we remove that from the circle? That can be done. Same thing with these investment companies that could be held under an active business, because none of this planning may be possible if you have an ineffective structure that we demonstrated originally.
Right. We don't have too much more time left. I mean, we started 5 minutes too late, so we'll be finishing in the next 10 minutes, but maybe quickly, if we could just discuss some of the benefits that are being utilized in this purification structure.
Yeah, so the very simple one, that we talk about a lot, is the fact that we're removing them out of the reach of creditors. That's one thing. At least we're making an attempt, although it's not rock solid. Anything can be challenged. If there's creditors at the door, it's a wrong time to be doing such things. Another big thing, of course, is determining, how we can best take advantage of certain tax benefits. So those are really the two big ones. But essentially, this strategy that I'm showing you here is an example of how it's done. You have companies that are, sometimes holding non-active assets, sometimes they're holding other subsidiaries. We can essentially go from this situation through a series of transactions under 55(3)(a) of the Income Tax Act that deals with what is commonly known as single-wing butterflies, which essentially provides the capability to move the assets that do not belong in the holding company to yet another company. It can also allow us to completely reconfigure an entire corporate structure under certain circumstances. So I think that pretty much answers the issues. Jordan, you mentioned about some of the risks previously. I'd say that might be a subject that's better served than another day as far as how you can avoid pitfalls, because there are too many to mention. There's just a few here. There's spousal attribution rules. There's minor attribution rules. There's reversionary rules that can go into effect that are very unfavorable in 75(2) of the Income Tax Act. Essentially, it's critically important. What I think we'll do at this moment is maybe open things up for questions. But before we do that, I'd just like to invite Vanny and Drayson into the office. Come on in, Vanny. and just spend a moment talking about our next seminar, if that's okay, our next webinar.
And
So,
Vanny is the CFO of our group.
Oh,
Yeah,
hi
I
everybody.
don't think you can be seen, Vanny. Come on
You
over
can't
this
be
way.
seen, just move over to the camera.
Okay, I can be seen.
Yeah, so wanted to just make the point, we've had a lot of inquiries on structured finance arrangements. And of course, one of the things that Vanny has become very involved with is structured finance arrangements for companies around the globe. And Vanny, roughly how many companies do you have? Just to give people a bit of a preview of what can be done. How many companies in the portfolio that you're currently managing?
And whatever we signed, the term sheet and all the process has been done is 21, but of course we have quite a lot in the pipeline also.
And of the 21 structured finance deals, what is the average value of the finance arrangement?
Of course, we are looking for minimum of 50 million, but most of this arrangement or project is over 100 million.
Yeah. Now, one of the things that you focus on a lot is ESG related opportunities. And one of the things that I've learned by, various trips I've undertaken on some of the structured finance arrangements to Europe and other places is that Canada and the US seem to be very far behind. You see, what is the reason for that? I'm talking now about ESG opportunities. And of course, we know Luxembourg has the only green bond index in the world. We know that there's a very different attitude. What do you think the reason for that is?
It's going to be a journey to reach over there, of course. Right now we are in the beginning of the journey. They are aware of it, getting aware of it, but in reality, we are very cautious about everything else except the environment, of course, because Canada is a big country and environment but it's right now is not the first priority of the mentality that we have, but if we are getting over there, and that's why it's a long way to go.
So I think the best way to define it is, just as a preview, anything that's in harmony with the UN 17 goals on sustainability.
True.
So anything to do with the environment that has a social impact is certainly really highly desired. I know that the group is working with First Nations on affordable housing. It's working on alternative energy. There's a project out of Europe that deals with providing energy without any CO2 emissions, without any traditional risks that, say, nuclear reactors provide by the use of thorium. There's a lot of projects going on within Canada for multi-residential properties that have superior energy conservation. In the event that there's a need for individuals in the audience who may be involved in either ESG related opportunities that have an environmental or social impact, or opportunities for either affordable housing or for other types of initiatives or projects, how can your group help them?
Okay, first of all, as you mentioned, the main point has to be ESG related.
Mm-hmm.
And the project has to be qualified for that reason on the 17 goals of United Nations that it's indicated that it's ESG. And when they are qualified for that project and the minimum requirement is 50 million, then they can contact us and we can help them to come up with that financing for their projects.
Great. I guess we don't want to spoil the message coming up on the next webinar, but nonetheless, the terms for financing, generally speaking, as I understand it, are 15-year non-recourse loans.
That's correct. It's a non-recourse loan means and also the interest rate is quite low for comparing with the rate that right now is globally is available for investment. And also it's a 5 years of deferred of any payments, and they will pay in the end of the term. It's a full payment. It's required to be paid end of the term.
What is the term of the loan normally?
The terms is 15 years, but depends on the project. Sometimes it goes for 20 years if it's longer.
And what is the guaranteed rate of interest for the 15 or 20 years?
It's a something between 3.75 and 4%. It depends on the project, of course, and depends on the situation, but that is the lowest that they are.
And you mentioned that there's no requirement to repay any principal whatsoever until the 15th year?
Balloon payment until end of the terms.
And
it is
interest,
15,
you're saying, is deferred for 5 years.
and the interest is deferred.
So essentially, there's no servicing of the loan required until year 6, is that correct?
The first
Correct.
5 years is not required.
Okay, so I think that's a bit of a preview for our next webinar.
Yeah, well,
Meanwhile,
the dates for this webinar will be announced quite shortly. But we just want to take a few minutes as well, just to address some of the questions that were submitted. And Todd, would it be all right if I read them out? Yes, okay. So the first question, this one might be for Ryan. I believe they're referring to wills in this case. But there was an anonymous attendee that asked, can a beneficiary be an executor?
Yes, beneficiary can be named as an executor on a will.
Okay,
Yes.
perfect.
Yeah.
That's good. That's good. Next question that we had was they were referring to purification at this point. And so they asked, is the 50% asset requirement at any point in the last 24 months? For example, what if a sizable payment is received, increasing the cash balance temporarily for a few days? Would that jeopardize eligibility for the lifetime capital gains exemption?
yeah, I mean, look, I've heard horror stories where someone parked $50,000 in their corporation for 1 day and has caused the loss of the capital gains exemption. I'm not suggesting that will happen. That seems very extreme, heavy-handed, and excessive. Having said that, that's sometimes how people are treated from a tax point of view. Hopefully not, but generally speaking, it's really a matter of saying to what extent is that 50% rule, how does it apply, and how do you characterize the assets? What I mentioned earlier, was there's case law that suggests that the funds are absolutely essential for the survival of the company. And if they're not, then they're considered a non-active asset. So I think it's pretty important to have it in place, but if you want to be really feeling secure and safe, then don't make any risk for that temporary few-day deposit that's received on funds. Have a dividend policy in place. All you do is write the check. Bingo, money comes into the active business, you write the check and pay it out. But done. You can worry about how you're going to book it later on. Your accountant can pay it out as a dividend if it's providing that there's an intercorporate dividend capability built in without the use of a holding company. In other words, can you find a conduit to move those funds from an active business into, say, an investment company? You really need to have full functionality, including a proper recipient company, and identifying within that circle of active business, what is your strategy in advance? You don't want to wait for a problem to happen and then run into a problem.
Right. Okay. There's a couple of other questions that we had as well. One person Charles had mentioned that they look at 4 to 6 months of regular cash flow as being on side for the purification test, and so they're asking if there's a rule of thumb. Yeah,
oh, Charles, wow, it's been many years. As long as you're the same Charles Roten, very good. Been acquainted with past life, but anyway. So yeah, the answer to that question, I think that's a fairly general approach, because at the end of the day, it's a matter of demonstrating the company's capability to survive. And I'd say the following, that during COVID, as an example, there may have been a justification for having a longer period of funds available to cover a longer period of expenses. And I'd say that it's very situationally evaluated. I'd suggest the following, that certain kinds of assets too are problematic. As an example, it might be that there's a vehicle needed, but you don't need a Rolls Royce. Maybe a Volkswagen is good enough. Maybe a Rolls Royce would be a non-active asset. You have a rental property, or say as an example, you have a business which occupies a building, and you're intending to claim the capital gains exemption for the shares of the corporation that hold the building. Well, it might be wise to think about, the following. Is 90% of that asset occupied by the active business? Do you have tenants? What percentage of the building is occupied by tenants? So I think that this is a big issue, and it's really a matter of judgment, and it's a matter of a filing position and as well as defensibility.
Another question that we had from Sonny asked, in the event in the slide that the bill C208 was being used in concert with a promissory note for the protracted payment up for the shares, do the children have to pay interest on the promissory note for the period before the note settled?
No, there's no requirement for the terms to be interest bearing whatsoever. It can be that it's open-ended as far as the period of time in which the promissory notes are satisfied, and they can be non-interest bearing notes as well.
Great. So the last question that we had was asking if there's any need to be concerned with the availability of safe income on 55(3)(a) butterflies to the extent that they cause deemed intercorporate dividends.
So I'm going to say no in general. 55(3)(a) essentially can be done as a single wing butterfly on the basis that safe income is not a factor. Having said that, contemplating a single wing butterfly in a multi-tiered corporate structure can be problematic, more so not because of safe income itself, but as an example, if you're paying an intercorporate dividend to a holding company, you don't have the same benefit of being able to utilize high-low shares that have a low puck and a high redemption value through an intercorporate dividend, only when that dividend is paid to individuals. And when that's being done, say you're paying high shares, and then subsequently you're trying to utilize those shares for purposes of a butterfly, well, then you have to worry very much about safe income. As a matter of fact, any dividend that's paid out of surplus to a corporation, you have to worry about safe income. 55(3)(a) is an exception to that, but at the same time, where you are undertaking to pay intercorporate dividends, even from an opco to a holdco, a double-tiered structure, you still have to worry about those, the purpose test. You have to worry about safe income. You have to determine whether or not you could potentially have a problem that can come back and bite you later on. But the quick answer for 55(3)(a) is that there's no cause to be concerned in most cases, and I emphasize in most cases, for the redemption of shares under 55(3)(a).
Perfect. That was really all of the questions that we had received on this program. And on behalf of Quantum Business Law, as well as Quantum Family Offices, I wanted to thank all of you for your support in our program. I wanted to thank our panelists as well for the contributions. And as I mentioned, we'll be announcing the details on our next program shortly with the dates as well. Thank you so much, everyone. I hope everyone has a great day.
May I say a closing disclaimer?
Oh, go ahead. Yes,
Just a
please.
standard disclaimer as advised by Law Society. So the views and information provided during our webinar are not legal information, and they cannot be constituted as an advice from an attorney to a client. We can only establish an attorney-client relationship by signing a retainer agreement, and you cannot act upon or rely upon the information that we have provided today. You have to exercise your own due diligence, and if you would like proper legal advice from us, contact us and consider retaining us.
Thank you, Ryan.
Thank you very much.
Thank you, everyone.
Thank you.
Take care.